Pasture Rangeland Forage Insurance, PRF, is developed, underwritten, and subsidized by the USDA Risk Management Agency. PRF was designed to help provide protection from increased feed costs due to forage losses caused by lack of rain. With this program, the rancher can select which acres they wish to insure. They may select different coverage level and productivity factor for each insured crop type in the county. Coverage under the PRF program is available for grazing and haying crop types. This plan is available in the 48 contiguous states. The sales closing date for this program is November 15th for coverage in the upcoming year. Coverage is based on rainfall experience of a predetermined grid rather than individual farms or specific weather stations. Lack of precipitation is the only cause of loss covered. Precipitation data will be determined by NOAA, and RMA uses this to calculate the final grid index. Losses are paid when the grid's final grid index falls below the insured's deductible. Coverage levels are available from 70% to 90%. Productivity factors allow individualization of coverage from 60% to 150%. Since PRF is an area-based plan of insurance, it's possible to suffer a loss on an individual operation and not receive an indemnity payment. Likewise, it's possible to receive an indemnity payment and not suffer a loss on your operation. Coverage for bee producers is available under Apiculture API. This provides coverage for lost honey production due to insufficient plant growth caused by below normal precipitation. Here's how PRF works. Daniel's a cattle rancher. He insures his 10,000-acre grazing land that's located in one grid location and selects two 2-month periods or index intervals, January or February, and April-May index intervals. The FCIC determines the county base value is $39. He selects the 90% coverage level. He has an exceptionally good area, so he selects a productivity factor of 120%. Example, county base value equals $39. Coverage value equals 90%. Productivity factor equals 120%. $39 times 90% times 120% equals $42.12 per acre. Since his coverage is 90%, his trigger grid index is also 90. Regrettably, there's a poor rainfall and the April-May final grid index is determined to be 72. Since the final grid index is below his deductible, there is a payable loss. The payment calculation is the difference between the trigger grid index and the final grid index divided by the trigger grid index. 90 minus 72 divided by 90 equals 0.2. This payment calculation factor is multiplied by the dollar amount of protection. $42.12 times 0.2 equals $8.42 per acre times 10,000 acres, which equals $84,200 of total payable loss. This payment will help Daniel meet some of his ranching expenses and keep his operation going. Your first and most important decision is to choose a specialist in this type of insurance coverage. Someone who not only understands the program, but can easily explain it and help tailor it to your individual operation. At Golden Pacific Crop Insurance, our agents have 2 decades of experience in crop insurance and still farm our own crops as well. We know full well what you face out there with ever-increasing regulations and food safety issues. Give us a call and learn how we can make this very important risk management tool something that can be easy to use and much more affordable than you may think. Call us at 559-825-CROP, that's 2767, or by email at dfino@goldenpacificcrop.com.